Gore Street Energy Storage Fund. This is an investment fund which exclusively invests in, as the name suggests, energy storage assets. Put this into context, because solar and wind electricity generation can happen at all times of the day, and often at times when demand is low, there's a need to store that energy to be used later. At the moment, battery storage is one of the few ways of doing so. And what Gore Street provides you with is an investment in those sorts of assets in the US, Germany, Ireland, and the UK. It's particularly attractive as an investment to income buyers because the management are targeting a minimum of a 7p annual dividend. And as you'll see on the screen, the company or the fund has got a market capitalisation of just over £500 million. Pleased today to be joined by Alex O'Kennedy, who is the CEO and founder of Gore Street. Alex, over to you.
Thank you very much, Keith, and good afternoon, everybody. First, a word on myself and Gore Street. So, as Keith mentioned, I'm the founder and CEO. We founded the firm back in 2015. We were in action really in 2016. And my personal background is nearly 20 years investing private equity, majority spent investing in the world of renewables. And next slide, please. We founded the firm as we wanted to make a material difference in our transition to a low carbon economy, which is a very big tagline and one that required us to narrow down. So as the manager, taking the range of experience that myself and my partners had in terms of investing renewables at scale in solar and wind, we determined that energy storage would be a fruitful area for us to help build our franchise. Next slide, please. So what have we been trying to do with Gore Street Energy Storage Fund? We're very proud of the development of this vehicle. We IPO'd the Energy Storage Fund in May 2018. We invented this asset class for the public investor. And through this vehicle, we aim to have certain characteristics we aim to deliver for our investors. We want to be the market leader. It would be very surprising if you heard a presentation from anybody in our business that said otherwise. We're one of the main players in the British market in terms of storage. We're probably the #1 player in the Irish market, and we've recently entered the German market and the North American market. We've been investing in energy storage since 2017, and so built up a very considerable portfolio, which I will take you through in a few slides. That portfolio we run to deliver a diversified set of income, a diversified portfolio. So we're active in multiple jurisdictions, but we're also in each of our assets in those jurisdictions, we're able to do multiple types of revenue activities. Our entire fleet is lithium ion. We work with some of the largest manufacturers in the world who build our assets for us. And so we have a very strong, proven technology and operational background that allows us to run these assets at a very high level of availability in very complex situations. We, as Keith mentioned, we aim to deliver a very good income to our investors. We underwrite our assets to a 10% unlevered. So we look to deliver a 10% IRR on the assets that we build and then own. And then from that, we deliver a 7p or 7% of NAV annual dividend. We're very proud of our performance overall. We delivered 13% to our investors last year, and the year before that, just over 14%. So very strong outperforming against our baseline underwriting. This session is around ESG, so I'm going to talk a few slides around how that becomes very important to the firm and to the performance of the firm in the later slides. Next slide, please. So this is a snapshot of our portfolio. As I mentioned, we've been active in the GB market since 2017, in the Irish market since 2019, and earlier this year, the German market and the North American market. Taking a step back, what's the driver of the growth of this portfolio? What's the driver of these assets being a critical part of our energy transition? Keith mentioned it. We've in the process of a large build out of solar and wind across the world. Solar and wind are excellent generation sources, and in many of the markets, increasingly, nearly all of them, they are competitive or cheaper than the fossil fuel equivalent. That excellent generation source, though, does come with some complexities. One of the biggest complexities is they are intermittent. So the sun will shine and the wind will blow when those two things decided to do that. And though over medium term, over months, over years, you can track and you have very good visibility of how much electricity solar and wind will deliver for you, on a minute by minute, second by second, it's very hard to understand exactly how much you will have. That growth of renewable power is also matched by decommissioning of coal, gas, and nuclear. And so the energy systems across Western Europe and North America have this large transition where the grid operators used to have very good visibility of how much power they would produce second by second, as well as have very good visibility of how much power was needed. That's changed, and that change is for the benefit of society by replacing these highly pollutant forms of electricity, coal and gas, with renewables, but comes with that complexity. Storage fills that gap. Our assets throughout GB, as we can see here, and throughout Ireland, and then clustered in North America around Texas, provide stability to the grid. They allow the grid to be balanced, to balance off renewable energy power and baseload power on a second by second basis. Overall, we like to say that our assets are a stabilization assets. We are long volatility on the energy system. The more volatile the energy system, the more our assets accrue value. Next slide, please. Turning to ESG. I think it's really interesting. This session has been really interesting, where we have three, I think, very different companies all approaching the investment thesis with the context of ESG. ESG has always been important to us in Gore Street. We founded the firm on the basis that we wanted to do good. We wanted to be a materially positive player in our energy transition. I think it's all very well saying that. It does require a lot of effort, and we as a firm have spent more and more human resources, more and more money resources in terms of being able to deliver for our investors a very good picture of what we are doing in ESG. ESG, three breakdowns. So environmental, we feel very confident that our assets are benefiting the environment. Without our assets functioning well, more renewables cannot get built on the grid. That is, in essence, the underlying premise here. Storage enables renewables to function well and more renewables to get built. So our asset base is allowing more and more renewables to come on the grid, and therefore less and less pollutant baseload power. There's also obviously other aspects of ESG. Social is a very important aspect. Social not only in our communities that we have assets, but also social within the company itself. We are very focused as a young progressive firm in terms of understanding how we bring multiple different backgrounds to bear on the investment problems that we face. And we're very proud of the mix of our colleagues in the firm coming from a range of different backgrounds, and a very healthy mix, we believe, adds to the investment profitability. And then finally, governance. We are committed to greater data capture. We want to be at the leading edge of disclosure, and therefore we're working with multiple agencies to be able to get our investors the information they require in the format that they need. Just a picture, a few moments then on the picture below. This is one of our assets. It is indeed shipping containers. These shipping containers do contain very high levels of energy storage, lithium-ion battery cells, wrapped with some very significant technology, connected to the grid and providing a critical service to that energy system. Next slide, please. Talking about then the aspect I called out around social diversity and inclusion, I think these statistics are really quite different for what is in essence a private equity firm coming from a very kind of traditional conservative background. Here, as you can see, we've brought together a range of different backgrounds in terms of ethnicity, in the investment manager. We're also working very hard to build up a gender balanced firm. And we do these not just because they're the right thing to do, and indeed they are the right thing to do, but we do these because we are a better firm because of it, where we bring more different ways of thinking to complex investment problems for the benefit of our investors. Next slide, please. The ESG world is complex. There is a lot of frameworks. There's a lot of regulations coming through the EU, coming through the UK, coming from the UN. We have signed up to multiple of these, working with the Sustainable Development Goals, working with the SFDR, PRI, TCFD, lots of acronyms here, I'm afraid. But all of these are important methods and processes and reporting standards that our investors want to see, and we want to produce for our investors. We're also, of course, very proud the London Stock Exchange chose to give us the Green Economy mark, and it's something that we aim to live up to. Next slide, please. I wanted to finish on a case study. Here's another one of our assets. This is in Northern Ireland. Ireland is one grid, one energy system. And our assets in Northern Ireland and the ones we're building in the Republic are providing this critical service. I've talked about it before, that without our assets, more and more renewables cannot get built. Without storage functioning correctly, we will have very serious problems in our grid, given the amount of intermittent power. Some of those problems leading to brownouts and blackouts. This Drumkey asset, commissioned over a year and a half ago, 50 megawatts, operating in what's called the DS3 contract. That is a contract through the grid operator, EirGrid, to provide balancing services to the grid, to make sure that the grid is balanced at all time with the various forms of generation coming onto it. Earlier in the year, late last year in November, there was a very serious imbalance in the grid due to a high level of wind and a low level of availability for some baseload power. And our assets kicking in to be able to provide that stability that continued to allow the grid to function as normal. So for us, as we sit here as investors and one of the largest investors globally into energy storage, we have a theme which is these are large assets supplied to us by very significant manufacturers with technology which is well grounded, providing a critical service to our energy system for which we are able to generate a very good return for our investors. So we feel very happy of the place we've ended up in the world of energy transition, and know that there's a large amount of work for us still to go, and we continue on a growth pattern, which, as Keith mentioned, our market cap is just over 500. We IPO'd in May 2018 at a modestly sized 30 million. So we've had very significant growth in the size of the investment trust, and we hope to see that continue in keeping with the growth of our market. Next slide. And next one. So overall, market outlook is very strong. Energy storage is recognized now as a critical part of our energy transition. It's outperformed against even our expectations from 2016, 2017, when we started looking at this market. The macro theme of climate change is not going away. So of course, there's going to be a continued growth of renewables. We would add in a macro trend around energy security now, which is more and more important, especially here in Europe, given the war. We as an investment manager, we're active managers. The diverse workforce that I mentioned earlier is focused on all the parts of the value chain in energy storage, from the origination of transactions, execution, construction, and asset management to the benefit of all our investors. We have built up a very large portfolio, multi-jurisdiction, with a large pipeline behind that and we intend to execute against that pipeline over the coming time. As I mentioned, we've had strong financial performance at 13.1% total return to investors last year, with the promise we made to investors around dividend of 7p or 7% of NAV continue to be adhered to. Thank you.
Thank you very much, Alex. So this is the last session. If anybody has any questions, would they please submit them as soon as possible? I'll go through these relatively quickly. They're probably very short answers, but I think it helps clarify questions in the audience mind. The first one, was there any particular reason why your share price was so weak at the end of last month? So over the last 12 months, the stock price has actually, compared with the market, done incredibly well. But there was a little bit of a hiccup. So can you just explain what was going on there?
There was a little bit of hiccup last week, yes. I would say without verging on politics, which I don't think would help anybody. I would say that if you looked at the overall renewable sector, which we are a kind of key part of, we have performed extremely well versus the rest of the market consistently over the last few years. Last week, there was a general perspective taken by the market that the risk-free rate had changed, that basically the Bank of England was moving up interest rates, and that the yield available on government debt was going up pretty heavily. We're not fully correlated to that for sure, but there is definitely some correlation. So I think at the times of really quite significant market turbulence, which we saw in the middle of last week, our stock price moved more than one would expect the very reasonably large asset portfolio producing very strong income to do so. But I think it is a factor of the turbulence in that market, underpinned by what was some pretty difficult political activities. I think today we look at our share price, we've recovered into the 112, 114 range.
Okay, so let's move on to a realm of a technical question. You've adopted the lithium-ion technology. What is the danger of it being superseded by battery technology development?
So we're all in favor of new technologies coming on stream that we can purchase and build for our assets. We look at things in two ways. One, we underwrite our assets to a declining revenue stream. So we believe our assets will make less and less money going forward. We're making most of our cash in the early years of the asset and then a declining revenue stream. Why do we underwrite to that? Because we assume that there will be cheaper technology put on the grid and will compete with our assets in the future. So we underwrite to that declining revenue. We think that is the appropriate thing to do. I would say we have been wrong on that over the last 2 years, as our assets have made more money, given grid connections are hard and supply chain is hard for some of the other players. The second thing I would say is we will add cheaper and cheaper technology to our portfolio, therefore lowering the overall cost of our portfolio. So there's an asset strategy, which is appropriate underwriting, declining revenue streams over the medium to long term, and there's a portfolio strategy of course, capturing better and cheaper technology for the benefit of the overall portfolio.
Okay, thank you. So some more specific questions now. Why do your Northern Ireland plants earn considerably more per megawatt than those in the rest of the UK? I think they're quite similar revenues. They are different systems though, right? So as I mentioned before, Ireland is one energy system. So the Northern Ireland Republic, the grid operator EirGrid, which is owned by the Irish government, has a different contract type than the national grid, which is the grid operator of England, Scotland, and Wales. So they're operating in different markets and some different characteristics. Overall, both markets for us are delivering above our base case in terms of 10% unlevered. We as an investment manager, I think quite uniquely, have made a decision that we want diversification in our portfolio between multiple markets. So we started in GB, we moved into the Irish market, we moved into the German market, and now North America. Our assets do more or less the same thing in all of those markets, and they're supplied by the same supply chain, but they do it in different flavors with some different pricing points. So it's not necessarily apples to apples, but from an IRR and return perspective, we're very happy that they're all overachieving against our base case.
Could you say more about your expansion in Germany and what the potential is?
Yeah, it's interesting. Mainland Europe has always been this it's slower development on energy storage. Energy storage, if I take a step back, I mentioned earlier that we are investors, we're long volatility on the energy system. If you have a energy system which is an island system, such as GB, such as Ireland, you have more volatility than if you are connected to a range of other grids, such as France and Germany, which are connected together. So they had better ways to balance their overall grid than, for instance, GB did, or Ireland, or in fact, North America. For instance, Texas is one grid, California is one grid with limited connections to the rest. So that has held back the development of storage a little bit in mainland Europe, but that has changed now. It has changed quite dramatically, of course, since March. In the geopolitical sense, the build out of renewables in Germany is really quite staggering how fast they are now approaching it, and energy security is also, of course, top of their attention. So we imagine that market will continue to accelerate. We were very happy to enter that market with a purchase of an operational asset from Enel. It well positions us in that market to understand how to make the right amount of money and to build the relationships there. So I think we're very happy to have entered at the time we did. We did it before the geopolitical event, and we are now well situated to be able to expand our footprint.
Okay, so the next question relates to the growth in EBITDA. How strongly do you expect your overall EBITDA to grow over the next 3 to 5 years, and why?
So obviously we're focused on growth here. We don't give out projections on EBITDA, but what I would say is that, coming back to some of the things I mentioned earlier, we underwrite our assets to a declining revenue stream over the medium to long term. We think that's appropriate given new players will come into the market. We have been wrong about that on the upside, because we benefited very heavily as the incumbent from other new players having difficulties getting grid connections or navigating the supply chain. We have very strong pipeline, very strong relationships with the manufacturers. So for us, as one of the incumbents, we don't really have, I think, the same problems other players do. So as I look at our pipeline, our published pipeline is about 1.3 gigawatts. That's about a £600 million investment target for the investment trust across multiple jurisdictions. We aim to execute on that at the present prices we see in GB market, in the Texas market, and in Ireland. We're generating very strong revenues, and we aim to have more assets to continue to generate more of those revenues.
Okay, so we're going to go to another poll in a couple of minutes or so. So if you have any more questions, please submit them. And the next question relates to: why do you formally link your dividend policy to movements in NAV when NAV can be unpredictable?
So we believe that we are on an upward trajectory on NAV. If you look at our NAV over the last few years, it's incremental growth every quarter, incremental growth driven by assets coming out of construction into operation, and continued strong delivery on our promise to investors in terms of the revenue per megawatt. So NAV continues to perform well. We wanted to be able to have a progressive aspect to the dividends. We wanted to reward our investors as the value continues. But we do have a floor. We have a floor of 7p, and then we have upside as NAV on NAV. So we think, especially in today's environment, that a progressive aspect to the dividend is appropriate.
Okay, so this is the last question, unless there are any more that have just come in. When do you expect material revenues to accrue from the Republic of Ireland capacity?
We have assets which have already just been energized, actually, in the Republic, and are going through testing. And so those assets will be generating revenue for us over the next financial year. We have pretty strong expansion plans there, taking us over the next 1 to 3 years, with 2 of our sites having strong expansion in terms of megawatts. So already energized one of our facilities will start generating revenue for us very soon, and then multiple more megawatts in expansion over the next 1 to 3 years.
Okay, well, thank you very much indeed.